Welcome back to the show. Let's talk to Connor Campbell, financial analyst for Spreadex. Morning to you, Connor.
Morning.
We've got three stocks to go through in this segment. Let's kick off with WPP, the stock code WPP. What are the headlines here?
Oh, it really hasn't had a very good year. You know, back in March, you couldn't really fault its full-year figures. They were pretty spectacular. You know, revenue was up 7% to a record 14.4 billion. Pre-tax profit was up 12.5% to just shy of 1.9 billion pounds. And like-for-like net sales, arguably the most important metric, were up 3.1%. However, Martin Sorrell sort of cast a very, very long shadow over the rest of the year. He said that in 2017, the company wasn't going to be able to manage anything more than, roughly 2% in revenue growth and like-for-like net sales growth, mainly due to global economic uncertainty and the fact that at the end of the fiscal 2016, WPP lost Volkswagen and AT&T. I think that amounted to about 2 billion in revenue from those two accounts. You know, since then, things haven't been very good. In April, its first quarter figures, the like-for-like net sales rose just 0.8%, which is, again, that's a fair way off the 2% target. And in North America, which is the company's key region, they were down 1.1%. I think in August, it had a dip as well because its Japanese rival Dentsu Aegis, hope I'm pronouncing that correctly, they slashed their own full-year target sales, full-year guidance, sorry. So it doesn't suggest a very good situation in the wider sector as well. I think our clients have been buying around that 1550 mark just because of, you can see how dramatically it's fallen in the last few months. However, I think like-for-like net sales are only expected to grow 0.5% for the half year. Again, that's a fair way off the 2% target. I think investor reaction is really going to be dictated on if WPP holds on to its full-year guidance or whether it now revises it lower again after a tough few months. But like I said, I think our clients are fishing around for the lows and hoping to see some kind of bounce and a slight bit of good news on Wednesday. Understood.
Let's go on to Premier Oil. What are your clients up to here?
It's had, again, pretty tough year, due to the wider oil situation, despite itself posting, a string of really positive updates. It finally finally closed out its refinancing deal in July. That was ongoing for months and months now. In May, said that it could significantly slash its net debt pile in 2018 due to reduced spending and significantly increased production in 2017. And most importantly, in July, you can see that huge bounce around the middle of July. It announced it found a major oil discovery in the Gulf of Mexico. I think it labelled it as world class. Premier Oil owns around 25% of the block that the discovery was found in. It said it can produce around 2 billion barrels of oil. A few days later, it announced that its production for the first half of the year was up 34.2%, I think to 81.7 thousand barrels of oil equivalent per day. Then they kept their full year guidance unchanged at 75,000 barrels. However, I think it's fully expected to revise those higher this month. They've had time now to look at the figures, work out exactly what the forecasts are for the second half of the year. So that obviously then leaves room for an upgrade to its earnings performance. So that's why we've seen our clients buying around that 52p, 53p mark. It's fallen since that Gulf of Mexico announcement in July. It's got some room to bounce back towards those levels now if it can upgrade its earnings figures on Thursday.
Understood. And let's wrap up with Computacenter, the stock code CCC. What are the highlights here?
It had a bit of trouble at the start of the year. Its statutory pre-tax profit fell 31%. The main issue's been in the UK. In 2016, it didn't get as many new contracts as it was expecting. However, it did mitigate the losses really by hiking its dividend 3.7%, so investors were fairly happy with that. First quarter, then in April, you can see it sort of bounces towards the end of April. That was due to it announced a 16% rise in revenue. I think that was due to its business services and sector's doing incredibly well, increased interest in that, especially in Germany, helping compensate for any weakness in the UK. Since then, it's had a fair amount of buy ratings and positive updates from analysts. It's doing very well at the moment. Barclays are expecting it to post a 2.4% rise in half-year revenue at constant currency rates, and expect to see a huge 41% rise in pre-tax profit as well. The only thing is, UBS have sort of warned that the UK sector is still soft, and if the economic situation takes a downturn in the UK in the next few years, which it may well do post-Brexit, that could be an issue for Computacenter going forwards. However, our clients are buying around that 875 mark. They're happy with how Computacenter's doing and the huge jump in pre-tax profit you should see on Friday.
Connor Campbell, thank you very much indeed.